How does microinsurance work for a small farmer who may have very little cash available?
See, I am actually glad that you asked that question, because if you look at microinsurance, at least in agriculture, that question is ill-framed, if I may say so, because what we do is we structure the insurance as a collateral against the credit. So part of the insurance is part of the interest rate. With the credit, in the places where I work, very often for the first time, people are able to borrow and purchase agricultural inputs. And with the purchase of the agriculture inputs, in turn, they're able to increase their harvest substantially. So they end up in the end of the day, they end up with an income that is double, 3 times, 4 times as much. So if you deduct the insurance premium from that income increase, it is almost invisible. So you mustn't, or one shouldn't see it as people don't have assets and they put cash on the table up front. No, they get the credit. They get the credit for which they don't have to put cash on the table. They increase their productivity, they end up with more harvest, they end up with more income, and from that increasing income, they pay back the credit and the insurance premiums. I personally run projects in 12 countries on the African continent, so I can give you examples from Ethiopia, Tanzania, Kenya, Mozambique, Malawi, Ghana, Senegal, Mali, Burkina Faso. They're all schemes that look at similar products. They may involve different partners. I'll choose an example because it may be interesting for others of what we call a public-private partnership. In northern Ethiopia, we work with the World Food Program on a scheme that is part of their safety net program. And as you may be familiar with the World Food Program, they give food supplies for free in case of an emergency. So in coming together with the World Food Program and Oxfam, we actually designed a scheme where instead of being compensated on a charitable basis, you are being compensated by means of an insurance mechanism. And for the people who cannot afford the premiums, they can work, and they work on climate mitigation projects. Like it's community work. They may be planting trees. They may be doing something for the soil, for the ground. So this is something, and the project is called R4, so it's the Rural Resilience Project that looks at the mitigation, the adaptation, and the risk transfer component. And that is one scheme that is part of an emergency relief scheme. Other schemes that we have up and running are really with smallholders that in cooperation, like with microfinance institutions or more smallholders that are on the ground. It's less of a part of a relief emergency government program. But we also have macro schemes where actually a government hedges their whole operations. Like, for example, a scheme with the government of Malawi looking at the national maize production and hedging against drought that would severely impact their national maize production. So that is something then the government of Malawi going out and saying, instead of ex post disaster relief, let's do something ex ante and let's purchase an insurance. So many different schemes, but the one in Ethiopia, I think it's interesting because it is also changing. It is also an innovative way by which now international, multilateral organizations like the World Food Program engage in innovative financial mechanisms.